Good afternoon, ladies and gentlemen, and welcome to the INCE GROUP PLC results presentation for the half to the 30th of September 2020. Throughout this presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab situated on the right-hand corner of your screen. Simply type your question and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it's appropriate to do so. These will be available via your Investor Meet Company dashboard. I'd also like to remind you that this presentation is being recorded. Before we begin, we'd like to submit the following poll. I'd now like to hand you over to Adrian Biles, CEO, and Simon Oakes, CFO of the INCE Group. Good afternoon.
Good afternoon, everyone. I'm Adrian Biles. I'm the CEO of the INCE Group. Thank you very much for spending the time to listen to our presentation today. I'm a city solicitor with 30 years experience. I've spent most of the last 25 years doing private equity transactions, and I'm the founder and a 16% owner of the group.
Hello, and I'm Simon Oakes, the Chief Financial Officer. I've been with the group since 2018 and have been in role as CFO since the beginning of this financial year in April. I'm a chartered accountant with a background in corporate finance and accountancy in the Big Four, both EY and Deloitte, prior to joining the group.
So before we kick off with the financial highlights, which Simon will take us through, we just want to say, first of all, that we're very grateful indeed to the commitment and the hard work of all of our colleagues who have helped us to deliver these results in very difficult circumstances over the last 9 months or so. And also to say that we're very proud of them. They've been produced, as I say, in some adversity, but we think they're pretty good.
Thank you, Adrian. And the slide in front of you, everyone, this is our first financial highlights slide. I think at the top, what I want to just say is one thing we said we would do is try to simplify the way we present our financials to everyone. I know we've had questions in the past about the complexity of the financials and the consistency. One thing you will see as you go through this slide and through the RNS information and the financial statements is we have now, with the auditors, agreed an alignment of presentation of the P&L that treats more sensibly certain items that were previously classified in different places, so you can see a consistency between the presentation here and how we measure the business and what we actually show in the financial statements. And I'm hoping that will add a great deal more clarity in terms of the P&L. And there's also some changes we've made on the cash flow, which I'll come to, which hopefully will show you how we're monitoring, again, our performance in terms of cash generation. In terms of what I've therefore put here, it's a bit more simplified than previously on this slide. So revenue for the first half of the year, 48.2 million, up 6% on last year. We're very pleased in the kind of current circumstances and in the kind of background market challenges with the pandemic that we've faced to have been able to deliver growth. And I'll talk a bit more about that shortly. In terms of adjusted profit before tax, that's the measure we look at for the performance of the business. Again, I'll come on to talk about the components that take you down to that in the P&L. That's at 2.52 million. Last year having been restated, obviously, after we did the updated acquisition accounting for the INCE deal, which you'll have seen in the March year-end results. Cash generated by operations, 16.2 million, over 10 million ahead of last year's equivalent. Obviously, in last year, we were contending with the sort of unwind of lots of costs and cash flow movements out in relation to the original INCE deal for the UK and for the then overseas parts of the business we bought variously in January 2019 and April 2019, and obviously the net working capital funding of particularly the INCE overseas offices that at that point were in some level of turnaround. I'll come back to talk about that in a minute, but just to point that that's a significant improvement in our view, and I'll, as I say, show you some of the other metrics we're looking at in terms of cash flow when we come to it. Finally, on this slide, net borrowings, obviously net debt has been a key metric that we've looked at in terms of performance. We're pleased to have brought it down from the equivalent last year. It was at 10.3 million, it's now at 8.3 million, and it's down from 9 million at the year end, March 20. And we're pleased we're continuing to bring down the debt, so I'll come on to and maintain cash balances at a period of time when there have been some significant challenges to us, which again, I'll come on to talk about. Adrian, if I can pass to you to talk about the operational highlights.
Thanks, Simon. The theme of this really is continuing to deliver on the business model. Having done the deal with INCE and having integrated that and having worked through most of the cultural and business issues arising from it, our job now is to leverage our operational leverage so that we can use the existing platform and drive more revenue through it internationally, and using the new service lines that we have to increase the amount of the client dollar that we're able to take. The operational highlights are generally around people. Our strengthened management team with Julian Clark coming on board as global senior partner, and his job really is to face the market and the clients and manage the fee earners and partners and their relationships with the clients to ensure that we maximize revenue, maximize collaboration between offices and service lines. And he's had a pretty tough start because he joined us as COVID started to bite. And of course, he really does need to get out and about and travel more than he's been able to. He did spend 3 weeks in Cyprus, where we opened an office with an existing team of shipping specialists, and I think he produced a piece of business more or less every day during the 3 weeks that he was there. So we really do need to get him out and about and seeing the troops and the clients when travel restrictions permit. Mark Tantum is a managing partner in the UK, and he has vast experience of running large professional services teams while he was a vice chairman at Deloitte and head of their forensics unit. And he's having a real effect in terms of focusing our heads of department and our partners on revenue, on client satisfaction, and on the delivery of bills and the collection of cash. And Alex Janes, who joined us from a very large US firm called Oric, is doing the same thing in the international business, where he's tasked with making sure that those offices operate on an integrated basis with proper quality control and a coordinated and cohesive approach to client delivery. As I said about Cyprus, we've established a new office there, and also an asset finance business headquartered in Abu Dhabi with 2 very experienced executives from the asset finance space, which is intended to help to service clients as they restructure or acquire assets of whatever sort, but obviously including maritime assets such as vessels, oil rigs, and that kind of thing. We have consolidated our office in Singapore, so that rather than having 2 businesses there, one which is a local law firm and one which is an overseas law firm, they're both now in the Incisive Law LLC, which is able to provide both local Singapore and English law from the same office. And it greatly improved the efficiency of that office, and we can now leverage that across the region and internationally. The lateral and team hires, which we've taken on, Simon alluded to Bentley's earlier, they're increasing their revenues and getting their feet under the desk, introducing clients to the firm and introducing new service lines to those clients. And that's reinvigorated the international offices, which are all now profitable. And I think that really does validate our investments in those offices, and also one of the principal reasons for doing the INCE deal in the first place. The remote working ability of the business has been amazing to watch, really. From time to time, we've had almost all of the people in the business working remotely during lockdown, and our proprietary practice management system, which is our own source code, our own program, it enables us to be highly flexible and to produce the management information that we want for the running of our business, which is helping Julian and Alex and Mark to deliver the results which they're doing. And that's been rolled out fully in the UK now. It's been installed in Cyprus, and it's ready to be rolled out across the international network when we're able to send our trainers off to the various offices to make sure that the system is properly installed and integrated and the people are trained how to use it.
Turning to the financial summary, as I mentioned earlier, I've set out opposite our P&L, which captures now the partner costs of all our partners through production staff, and is now consistent with the way we present in the financial statements. We've aligned them with this, so you see one version of the truth, and hopefully, as I say, that will eradicate some of the confusion I think there's been in the past. Going to the numbers, We talked about the revenue. It's 2.9 million ahead of the prior year. We're very pleased with that. And within that, there's a level of organic growth, 1.6 million. How we look at organic growth and so inorganic or acquisitive growth, for it to be inorganic, it's where we've brought in new teams or acquisitions or partners where they've brought a specific client following, or they've brought a service that wasn't previously offered by the team, by the existing group. And the two key ones there this year versus last year are obviously the Bentley's team, as we were mentioning, which is a team of fee earners who came into the business in January, so team hire effectively, and have a specialism in yacht and super yachts, marine law in the UK, and they've delivered over £1 million worth of the revenue growth in the first half of this year. That's in the acquisitive pot, and also the incisive element, the local Singaporean law firm that's been consolidating the group for the first time this half. That leaves then, as I say, the organic growth, which is at 3.6%, which in the market circumstance we're very pleased with. And our gross margin is also up. I think it's important to point out 44.5% versus 40.8% last year, a 3.7 percentage points increase. And this first half of the year being largely consistent with where we got to for the full year. And I think the importance there to mention is, as you'll have seen if you've looked back over our previous presentations, what we typically see is the first half of the year being slightly slower than the second half of the year, when there's usually a ramp up in billings and also in collections. So we tend to see margin go up because the revenue increases and flows down straight to the bottom line, and collections come in as our partner remuneration model is based on people being paid out on fees, both billed and collected. In terms of where we see that going this year, there is obviously a level of uncertainty still in the market, and we will talk in a second about our different markets. But the extent to which we're going to see that second half seasonal skew, we're not totally sure at the moment how it will manifest, whether it will be up or down, which is part of the reason why we're being cautiously optimistic and possibly a bit conservative in where we see the year coming out. The aspiration for us is to look, at an adjusted profit before tax, which is the bottom line here, of 10% of revenue. We're obviously at about 5.2%, again, accepting that there is a slight skew to that. And in a typical year, you would see that go up naturally with the trading profile that you'd see in the second half versus the first half. One thing to say on that number, our overheads, they're above the target we set for ourselves. We typically look to sort of trend overheads down to about 30% of revenue over time. We obviously scaled our overheads for the higher pre-COVID revenue targets we were aiming for, which obviously we're not there in that terms of that revenue level at the moment. And as a consequence, we have done a number of things to reduce overheads. We've looked where we've had dual supply from the combination of the legacy Gordon Dad's and the legacy INCE businesses. And we found some areas where we've been able to reduce those costs, but obviously those reductions have happened this half of the year, and the full year effect of them won't be seen until next year. We've also, where we've taken furlough grants, which we've said before, we have taken furlough grants in the UK in certain areas of the business. Where those have been taken, the headcount reductions, which again previously reported, have been taken such that there would be an offset of the reduction continuing on through headcount reductions once the furlough unwinds. We know we've got to get those overheads down over time. Some of the work to do that, as Adrian mentioned, the proprietary practice management system, once that is introduced to the overseas offices, we think there'll be efficiencies that are driven out that will bring down the overheads of the group as a whole, because of the greater sort of granularity and real-time information we'll be able to get out the systems. We're not there yet because, as we noted earlier, there are travel restrictions on us getting around to practically implement those systems. And the extent to which we can do that is going to be something that will be determined by travel restrictions being lifted, which we don't quite know when that will be at this stage. In terms of the split of revenue around the group, I've put it into the buckets here, comparing this half year to September versus last half year to September. UK, EMEA, and Asia, which are the kind of key boxes that the revenue falls into. You see both Asia and EMEA are ahead at the revenue level, and that flows down to gross margin. We're very pleased about this. We expected this to be a trend. The businesses have traded well and kept activity up through the pandemic, and have continued on what we expected to see from them, which is an improvement in revenue as part of the turnaround we knew they needed to do. Obviously in Asia, you really saw that in last year's results as well. Now in EMEA, you're seeing that come through in this first half. You can see that they've gone from 31% gross margin up to 38% in the first half of the year. The UK's revenue is down. We expected that the sort of slice of the pie that went to the UK would slightly diminish as the other overseas offices grew naturally, pandemic or no pandemic. The UK does contain our most sort of transaction-based parts of the service we offer, the corporate departments and the retail and the real estate departments, for example, which are more exposed to slowdowns in market activity, and therefore have been hit perhaps a bit harder than other parts of the group. The sort of positive we see at the moment is that the activity levels going through September and on through the couple of months since, in terms of matters opening and sort of fee earner activity a month, which we can monitor now through the sort of information we have in real time in the UK, has definitely picked up, and we're very pleased by that. And also, we've been able to protect gross margin by focusing very much through the new management structure on maintaining gross margin. You can see that the UK's gross margin has increased slightly despite the revenue decline. In terms of cash flow, I presented quite a detailed cash flow on the right here. This is all taken from the RNS information. The key thing that I've included and that we now include as note 13 to the cash flow, which you'll see, is free cash flow, and that is where we classify things slightly differently, consistent with what we've seen from our effective peers in the market, to talk about what we see as the free cash flow of the business being that which we generate before paying out any sort of dividends, unusual one-off costs, or any pay downs of debt. I'm pleased to report that is at 1.4 million for the first half of the year, compared to the cash outs that we saw in the first half of last year, largely as a result, as I mentioned earlier, of the unwind of costs from the original INCE acquisition, and then for the full year, also in part impacted by the effect we previously talked about COVID having on Q4 in terms of collections, etc. We've continued that free cash flow is net of partner remuneration payments, and also importantly, payments of deferred consideration, which we've made 5 million of those and started to bring that balance down. It's also net of lease costs, being the cost of our property portfolio. Clearly, we have a significant property portfolio in the UK. That obviously we're not in the office full time. Again, we're largely working from home. Clearly, there is an opportunity for us to look at that over the next couple of years and see what we can do about that. One benefit we have is that which we see as a good benefit for the business, is that we have very short term until break clauses on all our UK operating properties. None of them are more than 2 to 3 years out into the future. And similarly, the deferred consideration will unwind in the majority over the next couple of years. So you'll see both those numbers start to reduce, which will mean that the free cash flow should start to really increase over the next couple of years. In terms of where we're at now, speaking about the key challenges we're facing in terms of lockup, which is the measure we look at in terms of net working capital, being our debtors, anything we bill to a client, and our WIP, anything where the work's been done but not yet billed to a client. That's increased from 108 days at the end of September 19 to 116 days at the end of September 20. We aim to get that down. We aspire to get it to 100 days and below. We did get below that at the end of March, and it's up now again. there's a couple of reasons for that. One is, we are seeing slower cash collections in parts of a business. There's a bit more time to sort of unwind cash from clients across the different components of our business. And also because our performance is a bit more skewed in terms of growth to the Asia markets that we operate in, they typically operate in a higher lockup environment anyway. Lockup tends to be higher than 120 days over there. And it's gone up again because although they've seen activity levels go up, there are some challenges around collections and being able to physically get around to see your clients, to engage them, to get cash on the matters you've got. As I say, once we get the practice management tool delivered and deployed around the group, we do expect to see that we'll be able to actively manage that with the local teams a lot better. There is just some restraint on us doing that in terms of the practicality of getting people over there to train up the teams and do the practicalities of deploying that software. We've repaid more tranches of our debt facility with Barclays in line with the scheduled repayments we have, and we continue to comply with the covenants on those facilities. Obviously, as we've mentioned before, that is a facility that we took at the time we did the first part of the INCE acquisition, which was the UK part, and that facility is really only a facility for the UK part of the business. We do still, as we've said before, have an eye to the future and what facility we should really have, and we do know we need a facility that is focused on the group, not just the UK parts of the business, and we continue to look at opportunities where they are there. But either way, we're pleased to have brought down the net debt, and we're pleased to have brought down the deferred consideration, and we intend to continue to do that. Adrian, I'll hand back to you for the summary.
Thank you, Simon. So to summarise, a robust performance. The business has been very resilient and certainly performed far better than our worst expectations or our worst fears at the beginning of March, when the full effects of the COVID pandemic started to be felt in the UK. Because of our geographical spread and our sector spread in terms of verticals which we operate in, we have been fortunate in being able to mitigate some of the ongoing challenges of COVID, but they're undoubtedly there, and in the circumstances the business has performed very well and resiliently. As I've talked about the new management and the efficiencies into the operation, we're seeing that really take effect, and we're confident that over the course of the next 18 months and beyond, the disciplines which are being introduced and the focus which is being introduced into the business will greatly enhance its profitability and cash generation. We'll continue to add on lateral partner hires and team hires where we can and where there is a low execution risk, and continue also to reduce borrowings and our legacy acquisition liabilities so that the balance sheet will be improved. And as Simon says, when those drains on the cash have been satisfied, then we will be producing a lot of free cash flow, which is a key measure to how we feel we're performing. We do have to thank our internal colleagues who have, in many cases, sacrificed salary and invested, therefore, in the business, and their commitment and loyalty and pride in the brand and in the business which they're in is very gratifying. And we feel we're now positioned to deliver value by way of capital appreciation and future dividends. We do understand how important dividends are to investors. Many of our own people are investors. And we do sympathise, and we have been as prudent as we can be. We've been relatively conservative, and we hope to be able to reintroduce dividend payments in the not too distant future. We also hope to see our market valuation start to come into line with that of some of our peer group. And we don't necessarily expect to be at the top of that peer group valuation, but we'd like to be in that peer group valuation and not where we are at the moment, which we feel is a significant undervalue. Thank you very much for listening to us, and we'll have the Q&A now.
Fantastic. Thank you, Adrian. Thank you very much, Simon. Ladies and gentlemen, do please continue to submit your questions using the Q&A tab situated in the right-hand corner of your screen. But just while the company take a few moments to review those investor questions submitted already, I'd like to remind you the recording of the presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard on the Investor Meet Company platform. Lastly, before I hand back to Adrian and Simon, I'd like to remind you that your feedback is important to the company. Immediately after the presentation is ended, you'll be redirected for the opportunity to provide feedback in order the company can better understand your views and expectations. Adrian, Simon, I haven't given you a great amount of time to look at the questions that have come through, and I think you touched on one that we had pre-submitted, which was with regards to the dividends, so thank you very much indeed. But if I could just ask you to perhaps start at the top of the Q&A list and just sort of go through and pick off those that you're happy to answer. All questions will be reviewed by the company and answers submitted on the Investor Meet Company platform where appropriate to do so. So thank you.
Thanks very much, Paul. A pre-submitted question: when do you intend to recommence dividend payments, and what amount would you expect to pay per share? Well, I think we've said that we do intend to recommence dividend payments as soon as we can, and that will certainly be reviewed at the end of the financial year in March 2021. In terms of how much it would be, that will depend on the free cash flow of the business at the time and what is sensible and prudent in the circumstances, taking into account the fact that we recognise how important it is and what shareholder expectations are. And I hope that answers that question. It's difficult to be any more bullish than that in terms of forward looking.
If I take the next questions that we've had, so there was a question about other revenue, the 655, which you'll see in note 2 to the accounts. What does this represent? It is some small part of our consultancy revenue. It's largely the employee benefits and financial advisory businesses we have, which are part of the Culver Group, which is part of the original Gordon Dad's business. There's then a follow-on question: have you had any success developing consultancy revenues, or has that been curtailed by COVID? I think just to say, yes, we have. We mentioned at the top, we have opened the asset finance practice, which would fall into the consultancy part of our business over in Dubai. But obviously, as Adrian mentioned earlier, there is some constraint on us developing some of the business as quickly as we'd like, because a lot of it depends on how quickly you can get out to see clients and how quickly you can get out and do marketing and with your teams. Next question: how much furlough revenue is included in these figures? What is the cash flow benefit? Well, actually, it's two questions. I'll take the first one. The furlough revenue is roughly the order of about £1 million. So the idea is that we would roughly have saved about the same in run rate terms for the second half of the year, to keep consistent with that from the other actions we've taken. What is the cash flow benefit of VAT deferrals, etc., and when will it unwind? There's a sort of mixture here of what you're seeing in the cash flows. Partially, if you think of it, what we've tried to look at is that the benefits we've taken have matched the pain we've taken in terms of slower cash collections. One key sort of measure I look at is we provide bad debts, and this will answer the question hopefully. We provide bad debts at 3% of revenue, and what we say is a bad debt is not necessarily actually a bad debt. It's anything that's over 180 days old we will provide 100% of. It's not a practice that we've seen across a lot of other law firms, whether they be competitors, like for likes or anything. It's a practice we think is prudent and the right way to manage the business. It's also not a practice that was in place in the old INCE business, so there is some cultural shift, particularly for some of the parts of the business that do have those higher lockup days. Typically, we try to get to 2% provided as a ratio of that amount provided in the P&L versus revenue. It's up at 3% at the moment, which is the kind of effect of about £1 million of cash, and you can see that kind of equates with where we've had to kind of defer cash to marry up from what we've done in terms of PAYE deferrals and VAT deferrals. I would point out that we've started repaying some of that already, where we've seen it fit to pay back. In terms of other operating expenses being up 6% year on year in H1, what is the prospect for H2? I think what you're going to see is them for now stay largely consistent. Most of the full year effect of anything that we've taken as a benefit on them will start to come through in the second half in next year. And we hope through the second half to continue to sort of reduce supply and sort of sensibly bring down some of the costs in, for example, our IT estate. Do partners and senior staff own more than 50% of share capital? Apology, I have to admit, I don't know the precise number to hand that they own. They do own a proportion.
It's not 50%.
Yeah, but not 50%. And I don't know if there's any other context to that question, if the person who raised it wanted to ask a follow-up. Amortization and deferred consideration costs are 1.5 million in H1. Is this going to be the same again in H2? It's linked to activity. So if there's more revenue, it will be a higher number because it is linked to, deferred consideration, and how it amortizes is all linked to the amount that gets billed. So if they bill more, there will be more in the P&L as a ratio. Adrian, I think this is probably a question that we might want to direct to you regarding market value. You mentioned, where would you expect it to be using an estimate?
I don't think we can really say. All I can do really is point you to the peer group, and one of the questions a bit further down talks about my comments about the peer group. Point you towards the peer group valuations and just see that 2.5 times earnings, we're pretty cheap. The peer group itself, I think, has got a range of companies in it, and I think that some of the valuations are what must be considered to be relatively bullish, and we wouldn't want to be sort of saying that we ought to be up there at the absolute peak, because it doesn't really give the business a lot to do in the sense that if you're already being valued at some huge multiple of your earnings, it's a fair old slog to try and match that, if you ever can. And I think that we would, in a sense, it might sound a bit counterintuitive, rather be slightly undervalued than slightly overvalued, because I think in either case it can be pretty tough for a management team. And what we'd like to see is something that sort of demonstrably that can be understood, that's comprehensible in terms of evaluation.
The next question: when do you expect to pay the next dividend? I think we've answered that question with Adrian's answer at the top. The question on, do you expect further exceptional costs in second half, and if so, quantum? The costs in the first half are a combo of the costs of the integration of Incisive, a couple of final legacy costs to do with the INCE acquisition, and also the cost of the headcount reductions. We aren't expecting significant costs in the second half. How much revenue growth are you looking to in the next year? We're obviously currently going through and starting to look at our budgets for next year. And obviously we've withdrawn guidance on future forecasts. I think the only helpful thing, Adrian, if you want to add anything here as well, the only helpful thing I would say is obviously we're trying to get to a point where organic growth at least is about 5% a year. We delivered slightly over that last year, and obviously 3.6% is not quite there this year, but I'd say we're only in half one, and in the context of a pandemic. So things go well in the market, we should be able to perform well in the second half of the year.
Well, I think the amount of management effort that's going into the business, one would hope that it would improve.
And then, are there any further redundancies? Sorry, there's quite a few more questions. Are there any further redundancies planned at the firm following the cuts alluded to in the results today?
I think the answer to that is there are no current plans for further redundancies.
Then what is the other income of 732 likely to continue? It is some final bits of income after some of the businesses that related to some of the businesses that come out of the group, particularly one that came out last year, GDFM. Some small level of it will continue, but again, no, it probably won't necessarily continue to that extent. Although again, if I was thinking about the longer term profit, there are things that are going through as adverse costs at the moment up above that would partially offset that if it didn't recur. We've had another question about peer group valuations.
I think I covered that.
Sorry, I'm just trying to go through quite a few questions. Thank you for all the many questions you've asked. How much benefit was there to first half profit from the lower partner remuneration? And when will this reduction unwind? There would be no P&L effect from that. It's purely a cash flow thing, if you see what I mean. The partner remuneration in the P&L is based on what is earned. So what you'll see in the second half will be determined by how the performance at revenue level goes. As I say, the partner remuneration in the model is linked to what they build and also what they collect. Adrian, a question: are you looking to expand into Europe, presumably further than we have, and is Brexit an issue?
Yes, I mean, I think the answer to the Brexit question is Brexit is an issue. I think it's an opportunity, in large part, for us to provide advice to clients both in the UK and in Europe as to how it is they will manage their businesses moving forward and how they will trade. And we're already seeing quite a lot of activity on the advisory side from that point of view. In terms of expanding into Europe, yes, I think where it looks like a sensible idea that is not going to absorb working capital, we will do. I think it'll have to be carefully managed. Fortunately, in the person of Alex Janes, we have somebody who's managed international businesses in Europe before and is very familiar with the methodologies for dealing with that. We already operate in Greece and in Germany, as you probably know, and Cyprus now, and it will be interesting to see from an international jurisdictional point of view what seems sensible next. We've talked about Singapore as a hedge against China, and that's interesting. And we see Southeast Asia as a region where we would like to penetrate a bit more. But in all these cases, it's a matter of finding the right teams of people to move forward with so that we don't end up trying to establish an office because we think it's a good idea. Either our clients have got to be there and want us to be there with them, or we have to identify a team that's got existing revenue and bring them on board. I hope that actually answers the question on international markets generally as well.
Yeah, I think so. The next question: the business will re-rate as we see current trends continue. What are the plans for regular updates before the financial year end? I think our view is, we do want to give more clearer information to the market, as we've said in this presentation and previously, and we want to give regular updates. I think the updates that we would give towards up to the financial year end will depend on whether we have something significant to update on. Then the next question, also removing intangibles, the company is in the net liability position. Anything to worry about there? No, I would argue not, because I think if you're removing intangibles, you're keeping in deferred consideration. If you think about the deferred consideration, which is a large balance on our balance sheet, that is payable over a number of years. As are the lease costs, actually. Sorry, you were removing the asset value of the operating leases on the properties, because IFRS 16 makes you put them in assets and in liabilities. So you'd net the two off. On the leases side and on the deferred consideration side, you've got to bear in mind that what we do with deferred consideration is effectively we recognise what the vendors, who are predominantly fee earners still in the business, are going to earn in terms of fees billed and collected, over the period of time of measurement, and then be paid out. And it's effectively, because really that's a kind of, in my view, a kind of salary cost of the business. It's effectively like accruing a payroll or a salary accrual for a number of years. So if you take off the top half and take off the bottom half, it's a slightly disconnected position. You mentioned cash will be in a good position in 2 years. If you're paying 5 million per 6 months to 15 months, does that mean paid off in 18 months? So hopefully 10 plus extra cash next year. I'm not sure it will quite. Sorry, I'll read the question out. So rather than my paraphrasing it, you mentioned cash will be in a good position in 2 years. If you're paying 5 million per 6 months in deferred consideration, 15 million left, does that mean paid off in 18 months? So hopefully 10 plus extra cash per year. I think there's two things there. It will be positive for the cash flow. We have a higher balance of deferred consideration than that. I think just to be very clear, if you're looking at the balance sheet, there's non-current and there's current deferred consideration. So the balance is down at about 30 million at the moment. Remember, that is an estimate based on the acquired businesses and the vendors delivering an expected level of revenue, and we forecast that at the kind of maximum they could do, because obviously if we get that forecast wrong and we accrue that wrong, when we pay out, it'll be an extraneous hit to the P&L at the time, which we don't want. In terms of the payoff, the payoff of most of the deferred consideration will happen in the period up to about December 22. Some of it will continue on. There is a couple of deals, the smaller ones, that run on for a number of years, and they're on a ratchet where the level drops down quite a lot after about year 3. There will be extra cash in the business. I think the thing to bear in mind is some of that deferred consideration is with fee earners who will then flip onto the normal model, and so they will still be remunerating. So it won't be that the entire balance of the 5 million we've paid has disappeared. A proportion of it will disappear. But if you're looking at a cash flow and then saying, okay, well, what does that mean for your longer term? Bear in mind, we look at this first half of the year as cautiously optimistic and positive, but it's not quite where we want the engine to be in terms of the cash it spits off, regardless of whether we're still paying deferred consideration or not. The next question: what was the date of the white and black sale? I believe it was the 29th of October, but it was later in October. Adrian, I don't know if you correct me on the date of that.
I'm just checking the date, actually. So I hope I'll get a response before we finish up.
Okay, I'll do that. Are you still targeting net debt of 6 million by fiscal year end? Obviously, we said we're withdrawing our forecasts. We would like to get that net debt down further as the year end goes on. And we have scheduled repayments that will bring it down in terms of the borrowing position. And we also have, the expectation that if things were being well, we would see our maximum cash uptake coming into the year end. Yeah, I think somebody asked a question, thoughts on why the market might be undervaluing the business, and you hope clarifications to the accounting will help this.
I think what we can say is that we do hope the clarifications to the accounting will help with this.
Yes, I would entirely agree. And you mentioned acquiring teams as a means of expansion. To what extent is the business exposed to losing established teams? I don't know, Adrian, if you just want to take that one quickly.
Yeah, I mean, I think it is the case that if your model is not remunerating people or rewarding people in accordance with what they expect, you're going to be vulnerable to teams departing. And it can be for other reasons too. I mean, not everybody is 100% coin operated. People have to be in a business which they admire. They have to be in a business which they feel secure with and which is honest and straightforward with them. And our job as management is to see to it that our teams, don't leave, and to see to it that our firm looks like an attractive place for people to come to because of the reasons I've mentioned in terms of transparency and fairness, and all those other things. And also, one does have to remember that in terms of the way that law firms are structured, our partners, the investors provide the capital for the business. The partners are not having to go to a bank to borrow money to inject as quasi capital or quasi shareholder funds into the business and commensurately take risks and sign on personal guarantees for leases and all sorts of other liabilities that might accrue to them. We protect our people from that. They're insulated from that, and the investor provides the capital for the business in return, for their return on that capital. And that makes it a very different model. So provided that we explain that to people correctly, our model where they get a fair shake in terms of remuneration, and they also get the prospect of capital appreciation and a dividend stream on top of that remuneration as shareholders, which of course it's open to them to do, it ought to be a win-win. And provided that the business and the market, or that the shares perform in the way that it would be logical for them to, it ought to be very attractive. So, of course, any business is exposed to staff turnover. All I can say is that so far, so good. Our staff turnover has been very low. and we hope it'll stay that way. I think that's.
I think you've pretty much covered. Yes.
I think the only final one was just the white and black question. Apologies, I'd said the 29th. It was the 22nd of October.
22nd of October.
Perfect. Look, Adrian, Simon, thank you very much. You've been very generous with your time in addressing pretty much every question we've had through. The company will review all the questions submitted today and will publish answers and responses on the Investor Meet Company platform where appropriate to do so. Adrian, just before we close off, perhaps I could ask you just for a couple of words to wrap up before we redirect investors for some feedback for you, please.
Well, I'd just like to thank everybody for listening to us. We hope that those investors who have got shares will have their faith in the business justified in the coming periods. We've all worked terribly hard during lockdown to see to it that the show stays on the road. Our people have been very committed, and we're very grateful to all of them and to all of you. Thank you.
Adrian, thank you so much. Adrian, Simon, thanks again for updating investors today. Could I ask investors not to close the session, as you will be automatically redirected for the opportunity to provide your feedback. If you've accessed the meeting from the website, the feedback page will appear in front of you. If you've accessed the meeting via the email, you'll be asked to log in and submit your feedback. It takes just a couple of seconds and be greatly appreciated by the company. On behalf of the INCE Group and Investor Meet Company, I would like to say thank you for attending today's presentation. That concludes today's event, and good evening to you. Thank you.